So if you look at this slide and the entire portion itself, right, you're probably looking at 4 components that have broken market direction into. Now, when I started off the webinar, I told you that it's a fact-based system, and whether there is any particular fact-based system that can actually identify where market is getting consolidating at the top, and once it is consolidating, are there inherent signs that the market is giving us in terms of breakdowns, at least from a short-term perspective on the technicals are concerned, and whether we should be getting out on all those aspects as well. On a similar note, finding the bottom of the market or whether the market is bottoming out, and any process related to that as well. So I think you're reading all these days, right? Distribution days, follow through day, and actually give you what all these mean. But I think there are 4 segments that I've divided this Ferris wheel into. The Ferris wheel is clearly getting divided as a confirmed uptrend where the markets remain in fine fettle. Leaders act very, very strongly, and distribution days are contained between 3 and 4. I'll explain that in just a minute. As soon as the distribution day stack up happens, and as the market starts breaking down its key technical averages, I think the stacking up of distribution day and key averages being taken off is an indication that the market is giving us that something is amiss. Leaders are giving way. There is some news on a macro scale, micro scale, domestic scale that the markets are trying to gestate. And therefore, I think the giveaway in terms of institutions actually starting to offload position, which becomes a driving force both in demand as well as supply, as I discussed earlier. The downtrend is obviously a trend where the market is actually coming off. There is huge volatility, there is huge disruption that is probably happening. There are reversals that are happening in most sectors. Most leaders are turning for the worse, and the distribution they pile up is happening even more. The rally attempt is where I think the entire focus from downtrend to rally attempt is finding the bottom for the market. And this is what we'll discuss in the next few slides as well. So let's discuss what distribution days are. So distribution day is nothing but where the Nifty falls 0.2% or more compared to excessive volumes compared to the previous day as well. So simply put, if the Nifty today has corrected 0.2% or more, say the Nifty has corrected 0.5% today, and today's volumes are more than yesterday's volumes, it will clearly get stacked up as a distribution day, and we'll count that as one distribution day. Now, what the entire logic or per the O'Neill methodology in terms of actually identifying these market tops is that the distribution cycle is countered over a 25-day cycle. So let's assume today is a Monday, right? And not a Thursday as we are speaking right now. So from today's day, which is a Monday, the next 25 days is what we'll calculate as our cycle. Now, for example, on this Monday itself, right, the market or the Nifty has corrected 0.4%. And the volumes on Monday are more than what we saw on Friday. So we'll obviously count this as one distribution day. Now this has been counted as one, and we'll take it till the end of the 25 days that we are counting in terms of a particular market cycle. Now in these 25 days, if the stack up happens of more than 4 distribution days, you're clearly seeing that the market is witnessing some pressure. So let me come to that. But if distribution days in this cycle are contained to 2 or 3, we are saying that the market, as per the O'Neill methodology and as per the market direction cycle as well, still remains in a confirmed uptrend. What do I mean by that? Most leaders in the Nifty, right? Most sectors are still doing well. Most sectors have not broken down the near-term moving averages, and most leaders within the stocks are carrying on the same trend as the index is carrying on that they represent. Now, to make things clear, technicals become extremely important in terms of selling. Every institution globally recognizes that. What we try to challenge ourselves is that we try to analyze a lot of fundamentals when the market is giving away. Now, there are reasons that a lot of institutions are taking that away, macro reasons, like you saw the Black Swan event in March 2020 last year because of the COVID pandemic. What you are seeing right now is, well, I think more domestically driven rather than global. But again, I think that COVID second wave has hit us really, really hard. And the implications of GDP degrowth, probably not growing at that pace, but cut in GDP estimates, cut in terms of the NPA cycle. I think all these aspects need to get monitored very, very clearly as well. Therefore, where you probably got a lot of aspects at play, you're probably also expected to understand that when supply comes through, and what I mean by supply is that when a lot of selling starts coming through. So I think the terms that I'm using is demand. A demand for a particular stock is buying, which happens in a particular stock. A supply is that institutions themselves, or a large portion of the institutions which still control that stock or own that stock, start dumping that stock or start selling that stock into the market. So if they start coming and selling aggressively in the market for conditions which are changing, right? And the market itself is, as I'm saying, is giving us that hints and indications itself. So in the 25 cycle, if more and more distribution days are counted, if the 21 daily moving average is the 50-day moving average is taken off on the index level, I'm pretty sure most leading sectors which are beta correlated, which means which are highly correlated to the economy as well, start coming off significantly as well. And a lot of leaders or a lot of stocks within those sectors will also be breaking down their moving averages. Now, the 50 and the 200-day moving average are extremely important. And a lot of institutions, not just in India, but globally, pay a lot of heed to that. So when selling starts happening, it's more technical. Don't try to justify fundamentals in that. Global institutions do not do that. Why are they selling? Because the market is giving us indications. Why is it giving indications? Because of certain factors, which in the market wisdom probably knows far more in its collective wisdom than all of us individually put together. Macro conditions are changing. As I said, I think India is going through its worst phase. So I think even if global cues are okay, domestic cues are pointing to a patchy or an uncertain time, and that volatility is something that the markets do not like. Third, I think global conditions, geopolitical tensions can reflect in terms of bond yields, right? And that was the subject of interest over the last few weeks. Yields also are a clear indication of that. Regulatory changes. And all that has an effect in terms of how markets react. What is a 50 and 200-day moving average? Very simple. I think it's the last 50 days action calculated on a moving line is called the 50-day moving average. The last 200 days action in the market is calculated by the 200-day moving average. So a lot of events which have happened over the last 10 to 11 months is a very sacrosanct level as far as the markets are concerned. However, I think if that stack up of the distribution days is far significant, it is a warning sign that the market is giving us. Now, what happened precisely in March 2020? If you can see my cursor, right, in Jan 20, Nifty made a high of 12,430, but it closed near the day's low. So what was happening is that if you look at this candle, can you look at this candle? This pink candle, right? The huge pink candle which has happened. And all these lines are the moving averages, as I said. The green line is the 21-day moving average. The red, as I just explained, is the 50 moving day average. The pink, the 100, and the black, the 200-day moving average. So institutions pay a lot of heed to these averages, specifically when it comes to technical matters and specifically when it comes to selling. So on Jan 20th, Nifty made a high, but it closed near its day's lows. What was this indicating, right? That even though distribution stack was not happening, it was giving you your first signs that the market is not able to sustain. It is opening high, but closing lower, which means institutions are distributing or selling that stock. And because the stock still remained in momentum or the market still remained in fine fettle at that point of time, the distribution by investors, institution investors specifically, was happening across sectors, across stocks. And therefore, the index was closing at its days when it just closed around its 21 DMA, if you see. And the next day, I think it reached that. In the next few days, till Jan 28th or the next 7 to 8 days, what precisely happened was even more interesting, right? What precisely happens is the distribution day count started increasing. So again, I think, as I mentioned, in this 25-day cycle, if the day count of the distribution day count gets restricted till 4, and the key moving averages are not broken down, like I said, the 21 or the 50. In this case, I think the 50 DMA came very close to D3. But if the distribution day count starts increasing significantly, we are expected to see the market come under pressure. Why? Because I think leading sectors are coming under pressure. The market itself is giving away. If the market itself is giving away, the weightage that a lot of stocks have. So you've heard Reliance having the largest weightage, followed by HDFC Bank, Infosys. Most sectors will start giving away in terms of breach of their key moving averages, which is the 20 and the 50, which is not a good sign. What it basically means is there is excessive selling which is coming through into the market. Where is that selling coming from? By institutions. Why are they selling? Because of a lot of factors in terms of macro developments. And at that point of time, COVID-related news was restricted till China, but I think it got flared up over the next few weeks, and you saw what happened by the end of March for the entire market itself. But the market will give you clues, right? And the clues are supposed to be captured by these distribution day counts as well. So as that stack up happens of distribution days, we will downgrade the market to obtain under pressure. What does that mean? Distribution days have gone beyond 4, remain between 4 and 8, 6 and 8, right? This clearly states that the Nifty is correcting, it is giving away. for factors, as I said, which can be any of these factors combined together. But institutions are selling their stock away. Leading stocks, leading sectors will all give away. And if the market starts breaching its 50 DMA, most leading sectors will give away, which means most leading stocks will also have a huge, huge amount of a downturn. If you clearly see in this cycle, a lot of distribution days got accumulated. So D3, D4, D5, D6, which means that 6 distribution days actually came through. We actually downgraded the market on Jan 28. So I think Jan 20th, as you see, Nifty made a high in the previous cycle. But in the next 7 to 8 trading sessions, there was a huge distribution day count happening, and it actually breached its 50 DMA. So once it's done that, it's a good enough sign for us to say that something is amiss. The market knows more than us, and let's not second guess to what the markets are saying, right? And let's react. If certain sectors are giving away their 50 DMA, if certain stocks have broken through their 50 DMA, let us get out of those stocks. Let us book our profits and sit on cash. Yeah. We might enter those stocks again once the market gives us those signs. Through, again, either the distribution day count happening or the market direction cycle improving for the better. Now, in this case, as the distribution clustering happened even more in the next few days, you probably saw pullbacks, but these pullbacks were happening on lower volumes. You precisely want to see averages on the higher side being taken by higher volumes, and precisely the reverse happening. So if key averages are not broken, but if the 21 is broken with a very low volume, you can probably assume that there is just a kind of a shakeout that the market is doing. It's just some minor profit booking happening within the bull market that we are. But if serious selling action is happening with serious clustering of distribution, as we saw in the March 20 crash, this clearly is an indication that the market is telling us to get away. We clearly got away from a lot of stocks, and in fact, we downgraded the market over the next few trading sessions as well, and we completely got off. By what I mean completely got off is that when leading stocks in leading sectors start giving away, when there is a reversal in most sectors that are happening for the market itself, and a couple of sectors just hang on their hinges just by the skin of their teeth, right? It is not a good indication. I think the institutions and the market know better than us in most cases, and let us respect that. So in this case, I think we got away. What happened after that? I think it was a knee-jerk reaction for the markets. We corrected significantly. Even the 200-day DMA got broken off over the next few weeks. And in that scenario, again, I think now we downgraded the market to a downtrend. Now, what this clearly means is as we downgrade a few weeks back, we actually get off and we avoid new purchases as well. Why do we do that? We do that precisely for the fact because we are really sure how much the market is going to fall. Let the market give us indications in terms of a bottom out process as well. So as we saw from the distribution day process, we can clearly see, I think, market tops being identified, not just this cycle, even the September-October fall, if you guys can remember, where the market actually came off quite sharply in those days. I think we ran this precise methodology in terms of distribution day stack up. We got out of stocks, but the exception there was, I think, certain stocks in certain sectors were not giving away. So a downtrend, when it happens in certain cases like this, where certain stocks are giving away, I think you should entirely give away. In the September-October fall, even when the market was downgraded, certain sectors still held up and certain stocks did not reach their 50. I clearly remember certain stocks in the insurance space, certain stock in the cement space, certain stock in the specialty chemical space. We still held on to the stocks for very, very limited quantity because these stocks did not give away their moving averages and the sector was also not reaching their key moving averages like the 50 DMA. Therefore, I think to run this simulation on market tops, absolutely good. Now, we waited out in this cycle for the market bottom and we actually waited out for the bottom out process to happen. Now, how does that bottom out process take place? So let me just take you back to the market direction slide as well. Now, what we identified here is that came into a downtrend because the distribution stack up had happened quite significantly. Now, once that intermittent kind of a bottom is created for the market, in this market cycle, and I'll come back to that in March 20, it was 7,511, where we hit to a lower circuits. And after that, we hit an upper circuit on that same day itself. So if the index is able to hold on to its bottom for 3 consecutive days, we will upgrade to market into a rally. We will still not be buying into stocks. Why? Because the volatility for the markets will still be pretty large and huge. And at the same time, I think certain stocks will be still be very, very volatile. Might give a good move, might not be able to sustain that move, might come off, might consolidate, might be moving on a sideways direction as well. But the first sign that we look out for is once that intermittent sort of bottom is created, we'll wait for 3 consecutive days of action where that bottom is not breached. So for example, 7511 which got created, if that does not get breached, and it did not get breached in the last week of March for 3 consecutive days, we upgraded the market into a rally attempt. But has the market definitely found its bottom? I think the best way to look out for is to wait for a follow-through day. You would ask me, what is a follow-through day? Like a distribution trend that we discussed, a follow-through day is after we see these 3 days of consecutive action when the Nifty intermittent bottom is not reached, we ideally would like to see the Nifty or the index, in this case the Nifty, have a rally of 1.5 to 1.8% or more with volumes greater than the previous day, and ideally volumes which are more than the average volumes of Nifty that they record. What does this indicate? It indicates that institutions are now trying to find the grip in terms that the market is probably gestated the worst as it has corrected. And as buying is coming back, I think the heavy buying itself above average volumes of Nifty or more than the previous average of the previous day as well, and a move of 1.5, 1.8 or 2% for the Nifty is a strong indication that the market is trying to find its bottom as well. Now let us come back to this cycle as well. Now, as this cycle got broken down, last week of March, we saw 3 consecutive days of positive action when the Nifty did not reach 7511. Now we upgraded the market to a rally attempt, and now we wait for the follow-through day. Now, when should the follow-through day come through? Because we are talking about a 25-day cycle, right? And 3 days have already been elapsed in terms of positive action of Nifty not reaching its bottom. From day 4 to day 25, if we see such a huge Nifty move, you're probably expected to assume that the Nifty has found its bottom and that the Nifty is trying to find its feet. So there will be a lot of sector rotation which will happen at that point of time. Classical defensives come to the fore, and classical defensives at that time did come to the fore, which was your pharma, to a certain extent FMCG, and certain IT leaders as well. While economic related sectors take a backseat because they're still not sure on the hit on the earnings perspective that these sectors will make. But again, I think as the markets get updated back, certain defensive sectors and certain stocks will show leadership position, which gets clearly reflected through the market direction cycle and through the sectoral rotation. The defensives come to the fore. As next few months passed, I think as the economy started unlocking itself and as numbers started coming through, which were better and better over the next couple of quarters, beta correlated sectors like autos, realty, cement, infrastructure, all started coming to the fore, and you saw humongous amount of movement from a perspective as well. And I think we got appropriate entry points in those next quarters as well for all these sectors under consideration. So to find out the bottom, I think this system is effective as well. We did manage to do that as well in the cycle and even in the October-September cycle, as I said. So I think clearly market direction, very, very important. If sector leaders are giving way, if there is excessive distribution day count, if sector indices are breaking its key moving averages and breaking down significantly with excessive volumes along with the index, I think there is a definite system that can be put in place like we've got at O'Neill, which can identify market tops. And similarly, in terms of finding the market bottom through the system that we've got, which probably gives us an indication that you're fairly in the system itself in terms of offloading your positions when it is required and getting at the right time into the positions and not getting caught at wrong ends of the market itself. Now, the current market, as I said, we have downgraded the market to downtrend a couple of days back. It is very, very patchy. Why is it happening? Again, I think the moving averages are getting breached quite significantly. Certain leaders, certain stocks, and certain indices have broken down significantly. Certain sectors like pharma, to a certain extent, IT are still holding out, but they're classical defensives in nature. And therefore, as I said, right, it's not necessary that every market cycle that gets downgraded, every sector will give away. March 20's fall was an exception because I think it was a black swan event that we are looking at. We did not know how to react. This time, again, I think it is deadly as far as the domestic conditions are concerned in terms of the second wave. And therefore, I think they are reacting differently to how the globe is reacting at this point of time. Whether it is macros, is there a downgrade that might happen? Is there a cut in terms of GDP forecasts? Whether any beta correlated sectors like bank, financial services, realty, whether we are talking about autos, will they feel the pinch in terms of lower demand, lower volumes, therefore translating into softer Q1 numbers and therefore softer earnings? And again, the earnings recovery postponed to the second half. All these factors are unknown. The market does not like unknown characteristics and unknown features, and therefore it reacts. We need to capture that reaction And therefore, we have downgraded that. Certain sectors are still looking quite okay. But again, I think we'll wait out now because we clearly identified at this point of time in terms of identifying when to downgrade the market. We were offloading stocks and kept a very minimal number of stocks into the portfolio, which probably are a little bit pandemic proof, if I would say at this point of time. A little bit of pharma, a little bit of the bottom market performance, including FMCG. But largely, we'll wait for that bottom out process to happen. Let those 3 consecutive days come through and let that follow through day come through, which will ensure that we actually take out these moving averages on the upside with larger volumes. It will give us the confidence. And again, certain stocks within sectors can reflect greater earnings momentum, where we can start taking positions as per the OEM methodology, where the entire focus in terms of earning momentum can be taken and put to heed as well.